afternoon, everyone, and thank you for joining us for our Pieces of the Puzzle webinar today. Where built for rent opportunities lie in the current market. It's hosted by SFRhub Marketplace, John Burns Real Estate Consulting, Realprotect, and Lima One Capital. Today, we're going to embark on a journey of insights with industry leaders in the SFR and BFR sector. The pieces of the puzzle built for rent opportunities that lie in the current market today, and we thank you for joining us. We've got a panel of experts that play on all facets and sides of the industry, and we'll be talking about opportunities in 2024, markets, rents, trends, economic impacts, underwriting criteria to evaluate new opportunities, and the availability of debt and equity for BFR and more. So want to give a big thanks to Sean and Amy on our SFRhub team for pulling this all together. They run our marketing and PR, and I want to get started real quick with a round of introductions. My name's Michael Finch. I'll be moderating today with our SFRhub companies, and I'm just going to go around the circle, starting with Don, who will be giving a brief presentation following our introductions. Don Walker, please introduce.
Thanks, Michael. First, thanks for SVN and for you for inviting me to be a part of it. As you know, I'm very passionate about build to rent. Could talk about it all day. So I'm a managing principal at John Burns Research and Consulting. I help run our consulting group. We also have a research side, and the research group produces a report that covers specifically BTR and apartments. And we've been heavily involved in the SFR and the BTR space since around 2011. For perspective, since 2018, we have probably completed 1,400 to 1,500 build-to-rent specific studies around the country. We've got a database of about 1,600 active build-to-rent communities that are in lease-up or stabilized, another 1,400 or so that are in planning through under construction. And we just recently completed a build-to-rent tenant survey with 6,000 responses. So we have a pretty good handle on who the tenants are, what they want in their homes, and what they want in their community. So again, thanks for having me, Michael.
Yeah, I really appreciate it, Don. And for those of you that don't subscribe to John Burns, strongly suggest that we read it daily and live and die by it in the industry. Nate, you want to go next?
Sure. No, thank you, Michael. And I feel like I'm excited to continue to follow behind Don, although it's going to be a tough act to follow. So my name's Nate Trunfio, Chief Production Officer here at Lima One Capital. For those of you that don't know us, Lima One is a nationwide private lender focusing on providing real estate solutions to residential-focused real estate investors. And our big knack and goal is to continue to be a solution provider. We do that in a diverse amount of ways. So we're nationwide, like I said, in 46 states. We're in markets small, big, medium, throughout all of that. As far as customer bases, we work with entry-level investors all the way up to serial, very professional operators as well. And then we also lend on numerous different products that suit the residential investment strategies. So that would be fix and flip, rental loans on single assets, rental loans on portfolios, multifamily mainly on the bridge and reposition side. And last but certainly not least for this panel here is our new construction product. We primarily focus on the vertical financing component of it. And then in the build to rent world, we're more on the lower end of the middle market, and sort of small up to the medium sized build for rent communities is sort of what we specialize in from a financing standpoint. But just excited to be here with this illustrious panel.
Yeah, appreciate it, Nate. And last but not least, Julie, who is with Realprotect, and obviously I'll let you introduce yourself, but a prevailing topic for today's environment for sure. Julie, go ahead.
Yes, I'm excited to be here, so thank you for having me. I am Julie Sanabria, the director of our real estate investment division. We are an insurance company that insures any type of real estate transaction, from single family portfolios, apartments. Now we're doing build to rent. We've also do property management. Pretty much any type of transaction we can insure or find a way to help you find an insurance solution. Currently, we're insuring about north of 40,000 units across the nation. We work with a lot of large lenders and real estate groups offering lender compliant coverage. I know insurance is one of the items that is a deal killer these days. And thankfully, as a retail agent, we do have access to over 200 different carriers. So we can try to find and negotiate coverage options in this difficult market. So I'm excited to be here and talk with you guys.
Wonderful. Well, thank you everybody again for joining, participants and panelists alike. And now we're going to jump in to Don Burns' presentation on what to expect in 2024, rent trends, comparison of product types, and much more. So listen intently. It's a wealth of information. And Don, feel free to take it from here.
Awesome. Thanks, Michael. All right, let's see if technology works today. So if you can give me a thumbs up if you can see that, Michael.
Looks good.
All right.
Thank you.
Oh my God, it works. Okay, great. All right, well, two things. One is in typical John Burns research and consulting fashion, I have a ton of data. The hardest part was getting this down to around 10 minutes. So that's what I've done. To do that, I'm gonna have to go fast. So at the end, I'll have my contact information. If you want the slides, I'm happy to send it to you. So you can either reach out to me or Michael, and we'll make sure you get a copy of these. So what I'm gonna cover today is a high-level economic and demographic overview. Super important things are going on there. We have to touch on the apartment market because that does influence rents for at least some of the products that we see in build to rent. Then we'll cover BTR market trends, and if time, I'll do a very, very quick wrap up. So diving in. So we're in the camp that we are going to avoid a recession, but we think we will have a pretty solid slowdown from a jobs perspective. So here's the good news. In January, we grew by 353,000 jobs, followed by another 275,000 in February. But we do think the spike in interest rates by the Fed to tame inflation will slow down job growth. It has to slow down job growth. Otherwise, they won't be able to get wage inflation down. And that's really what they need to do. So you can see we're forecasting some pretty muted job growth, but remaining positive through 27. This is another slide that kind of shows a similar thing, that jobs are slowing a little bit. So job openings, we had a peak. It's crazy, 12 million job openings in 22. That's now down to 8.8 million. That's so, but it's still great. There's 1.4 jobs for every unemployed person. So this is why the Fed is saying, you know, we might do 3 interest rates cuts this year to make sure we have a soft landing. But this is what they're fighting is wage inflation. All right. So with that though, wages have been going up. Last year was 4%. We are thinking that there's still a shortage of workers, and we're forecasting 3 to maybe 5% annual household income growth through 2027, despite slowing job market, just because we don't have a ton of workers to fill those jobs. All right, next thing I want to talk about are domestic migration trends. And coming out of the pandemic, there was a ton of economic stimulus to protect the economy, as everybody knows, about $5 trillion, I think. And what we think happened is that accelerated household formations, and with technology, people can then work wherever they wanted or live wherever they wanted, but maybe work in a company that, you know, is in a high cost area. So when you look at these graphs of the United States, the darker the color means more extreme. So from 2021 or 2020 through 2021, the red states, California, New York, Illinois, lost people. People were moving out, and they were moving into the areas that are green. So red bad, green good. And you can see there was pretty fair amount of movement into Texas, into the Carolinas, Florida, and even in the Northwest. Then in 21 through 22, you can see those colors mute a little bit. And then in 22 through 23, it got even worse. And what we're seeing, and we're updating domestic migration monthly, is that some MSAs growth has really slowed down dramatically. And Dallas is one example. I think in the peak, maybe 18,000 or so households, net households moved into Dallas. That slowed down to around 4,000 or 5,000. Now, the good news is, since that migration has slowed, our population growth has finally started to take off. And so we have Chris Porter on our team. He's a senior vice president and chief demographer, and he's diving into the demographic trends on a daily basis. That's his focus. And you can see here, we were not losing, population growth was slowing for the past plus or minus 30 years. But in the past 2 years, we've seen some really strong growth. And even though the census is saying in 23 growth was probably around 2.1, we believe it was closer to 3.8 million people, driven mainly by immigration, international immigration. Now, the interesting thing is about 50% of that immigration lands in 5 states. And this is the numbers I'm showing here are based on the lower Census Bureau data. So we need to multiply this to reflect the 3.8 that we just concluded a couple weeks ago. But basically, those people are moving into Florida, California, Texas. So it's offsetting that slowdown in domestic migration. So it's probably not felt as much. All right. And so what that did is it caused us to increase our forecast for the need for housing over the next 10 years. And so let me run through this. So we think there's about 13.7 million households or housing units that are going to be needed just for household growth. But then we have another 500,000 second homes that we're going to need. So from a growth perspective, 14.2 million homes. One thing that people forget about is replacements. There's tear downs, there's natural disasters, but over the course of the year, we typically build around 250,000 homes to replace homes that are torn down. And then Chris and his team have determined that we think there are about 2.1 million undersupplied homes right now. And that does vary a lot by market. And I've got a map of the US that shows that. So green again would be undersupplied markets, red would be oversupplied markets. And you can see how it varies dramatically around the country. All right, jumping into the apartment market trends. So as a lot of folks know, again, coming out of the pandemic, a lot of people wanted to decouple from a roommate situation and moved into their own apartment unit, as well as that accelerated household formation I was talking about, part of that. And so the apartment developers responded and started building a lot of apartments. And you can see here, since going back to at least 2011, we're delivering a huge number of units, about 440,000. And there's another, I think, 990,000 that are still under construction that will deliver over the next 12, 18, 24 months. So what that's doing is putting downward pressure on rents and occupancy trends. And so just really quickly here, the bars show where current occupancy is at. The blue dots show where historical averages are for occupancy on a market by market basis. And so you can see in most markets, occupancy is lower currently than historical averages. Now, there's a little bit of good news coming our way in the apartment market, and that is builders, developers have pulled back significantly on new permits. In some markets, 25 to 50%, others 0 to 25. And there's a few markets that are still positive. But what that's doing for us is it's saying, all right, we're going to be slow for apartment rents in 24, maybe the first part of 25. But then as those units get absorbed, we'll start, and we have this strong household formation going on. We're going to start to see stronger and stronger rent growth, progressively getting stronger through 27. That's our forecast. All right, jumping into the build to rent market. So Michael asked me to put together a little slide here that shows the typical product that we see. So there's horizontal apartments, single level row homes, townhomes, and detached. And just a quick run through each of those. So horizontal apartments, the better name is cottages, but industry calls it horizontal apartments. Those are really just 1, 2, and 3 bedroom units that you would find in a typical garden apartment, ripped out of those buildings and put on a multifamily zone parcel, they're just not stacked. You get a little private rear yard, and people love that product. It gives you a lot more privacy, room for your pets or young children to play around. Then we have single level row homes, and those are typically 1,000 to 1,700 square feet, 2 and 3 bedrooms, 1 or 2 car garage, and a private or semi-private rear yard. It's a very, very popular product among mature renters. And we keep that separate from the townhomes, which is the next category, because they're in different locations and different tenant profile. Townhomes, this is your typical 2 to 3 story townhome unit, sweet spots, 1,300 to 1,800 square feet. We see those a lot in coastal markets and infill areas. Then we have single family detached. Sweet spot there again is 1,400 to 2,000 square feet. And some of those communities come in amenitized or non-amenitized. Some are targeting entry level and some are targeting luxury. So those are the 4 we see most often, and they relate to the next slide, which is our map of our database of, we're almost at 1,600 active build to rent communities. So this map just shows the active communities, and they're color coded by the type. And we also have a separate map that I don't have time to share today that has about 1,200 planned or BTR communities that are under construction. These are communities, not unit count. And you can see that the single family detached and the horizontal apartments, a lot in the Smile States in those high growth markets. Townhomes, you can see in the orange there, in the coastal markets, the expensive areas, and within MSAs, they tend to be in infill locations. So actually, townhomes have the highest average chunk rent of all product types that we track. And single level row homes, kind of the green color you can see there, are concentrated in the upper Midwest, but they're also in other markets, Carolinas, and actually throughout the Smile States as well. All right. And then next is, who is the renter? So this summarizes some of the stats that we got from our build to rent tenant survey, where we had over 6,000 responses. And so they're much more affluent than a lot of people think. 47% earn $100,000 or more. I would guess the median income is probably around $125,000. We have one client whose average income in their community is over $350,000. So certainly these are people that can afford to buy, but are choosing to rent for a variety of reasons. Another interesting tidbit came out of the survey. 32% of them have owned a home before. And actually, for the mature renters, about almost 90% have owned a home. And they just basically said, look, we're tired of maintenance. We want flexibility. And so we're going to sell our home, move into a built to rent community, and enjoy life more often rather than spending time maintaining a house. Families, 58% of the folks living in detached homes are with children, which is way different than single level row homes and horizontal apartments. I've seen as low as 10% of units are occupied with children there. Pets, very important. I was surprised, actually. I thought the number with a dog would be higher, but 45% have a dog, 16% have a cat. And they're also moving into your area. So 62% of the tenants are from a different city or state. So definitely a transient type population looking for a new place to live. All right. So now what we're seeing in the build to rent space was very similar to what we saw in the apartment. Coming out of the pandemic, huge demand for the product. Builders responded, pulled permits and started a ton of units. I shouldn't say a ton. Relatively speaking, it's a drop in the bucket, but over the last 12 months, delivered close to 90,000 build to rent units. It sounds like a lot. We think starts are going to come down quite a bit for the same reasons we saw on the apartments. The rents growth has slowed. Costs have increased, especially, and Julie's going to talk about it later. Insurance costs are up, but really the cost of capital has gone up dramatically. But we think in the long run, 90, 100,000 will definitely be in the hunt for a new norm. Every quarter, we survey brokers about who's buying land. And just for this presentation, focus on the purple color if it shows that way on your screen. That's the share of build-to-rent operators that are buying lots. And you can see the growth really spiked in the third and fourth quarter of 22, where 15% of all finished lots were sold to build-to-rent operators. And you can see how after interest rates spiked, that came down a lot. So in the fourth quarter, only 5% of the lots were being acquired by build-to-rent operators. So that's another reason why we think starts for build-to-rent are going to be down 50 to 80%. And in the long run, that's going to help with rent growth, which I'm going to show on the next slide. So this is a national number. It's based on about 500 build-to-rent communities. So this is comparing build-to-rent rent trends, the dark blue line, versus apartments in green, scattered SFR in orange. And you can see build-to-rent spiked at 16%. But then as the economy got a little bit shakier, inflation bit, rent growth really slowed. And in the last 12 months, you know, we're seeing about a 1.7% year-over-year rent growth for build-to-rent. And you can see we're thinking it's going to start to grow back to its normal rate. I'll say around the 3 to 4%, probably beginning toward the latter half of 25, but growing into 26 and 27. This next slide compares those same product types, but occupancy trends. And clearly you can see that landlords for build-to-rent and apartments were trading rent growth for occupancy. And so build-to-rent's kind of stabilizing at 96%. Apartments are still ticking down every month, just slightly, just under 94%. All right, I just wanted to show this really quickly. It's comparing the rent growth for the 4 main product types. You can see in the light blue line here, horizontal apartments were extremely popular coming out of the pandemic. Rents actually grew by 24%. Now that sector is given back around 3 to 4%. But I can guarantee most people were not underwriting rents to go up by $500 to $600 or more when they first did these deals back in 2018. So still in good shape. You can see here, this is occupancy trends for those same product types. Horizontal apartments really took the beating. And again, the reason why there is because they're so closely related to garden apartments. So as we see an oversupply of garden apartments, it's certainly influencing the horizontal market. This is just a picture of year-over-year rent growth for build-to-rent in about 25 or so markets. And you can see they're not all the same. Some have actually seen a little bit of negative growth, but others have seen up to 6 to 10%. So just really quickly as a wrap up, in 24, we think we're going to continue to have job growth slower than we had, but still more jobs. We do think we'll see slightly lower interest rates. That's what the Fed has been telegraphing. We think we'll have higher home sales for both new and resale because of that household formation, but also with lower rates, which will allow higher home prices. We think apartment rents will stay flat in 24 due to the supply issue we talked about. SFR rents didn't spike as high as apartments or BTR, so we think there's more room to run there. So we think rents will grow 3 to 4% this year. BTR, we think we're seeing a definite pullback in new starts now, but in the long run, we think 90 to 100,000 is probably the new norm. And we think build-to-rent growth in 24 will be muted, but then as we roll into the latter half of 25, 26 and 27, we'll see progressively stronger rent growth. And so there's my QR code. If you want the slides, you can take a snap of that, shoot me an email, or like I said, shoot an email to Michael and we'll get you the slides.
Don, really appreciate you presenting that. Tons of great information there. And before we get into our talking points, and I have a couple comments or questions on some of those, but Julie or Nate, anything come to mind that you'd like to ask Don for the presentation?
Nothing overly specific. I'm going to have some questions probably as we get into it, but always enlightening information from yourself, Don, but also on behalf of John Burns Group. So a lot to absorb and digest there. Certainly some good factors. I guess maybe that leads me to one question while I'm sort of thinking out loud here, Don, is, you know, what do you think the biggest tailwind is for build to rent right now?
Well, I think there's a couple things. First of all, there's around 14 or 15 million occupied single-family rental homes in the country. Surprising to a lot of people is that number's come down over the past few years. So coming out of the great financial crisis, a lot of mom and pops bought single-family rental homes as an investment, and they have seen some really strong price appreciation. At the same time, they probably said to themselves, wow, managing 1 or 2 homes is not a lot of fun. So I think a lot of them have cashed in, sold their home. So the actual number of single family rental homes have come down. But what I see as an opportunity for build to rent is these are brand new homes, much more energy efficient, professionally managed, and that's a big part of why people want to live in these communities. As a matter of fact, that was professional on-site management and maintenance were 2 of the most important reasons why people chose to live in their build to rent community. They wanted to know that if they had an issue, it was going to get fixed now and not 2 weeks later when mom and pop, grandma and grandpa get around to the house. So I think, and on top of that, that immigration information that I talked about, we think with that surge in population and immigration, most of those immigrants will probably rent before they buy. For a year, every year, that's became BTR. So we think, there was a base, an underserved base of that 14 million that want a newer home. But now with the surge in population growth, there's going to be a lot of demand for apartments and BTR coming our way.
That's interesting, Don. That was kind of a little bit to one of my questions, and I think I had read, and you'll know better, but the post-pandemic, baby bump spike, I guess if you want to call it that, I think added some to population growth, and it seems like a majority though is more akin to immigration growth, which obviously helps our labor markets, and I think the baby bump short little spike there, will benefit, family formation for build for rent product. But how do you think the spike in immigration exacerbates or affects our affordability issues? Because I don't think many of them are going to be typical build for rent renters.
No, most of them probably won't be, but there will be some. Certainly there will be some. I think it probably helps us in a couple of ways. One is it does create, it probably does create a bit of pressure on rents. And so really what we need to do is we need governments to help get out of the way and get homes built. We have an undersupply of at least 2.1 million homes today. So, we're currently not building enough homes. We're still every year not building enough homes. So that number is growing, right? And so the good news is I think a lot of the immigrants here will probably help build these houses that we need. So the labor shortage that we saw in construction, now we should have more people available to build houses, which is a good thing. So that will offset some of that wage inflation pressure that the Fed's feeling. And so there's some pros and then some cons that we have this demand coming our way. But really, as a society, we need to help get homes started. That's been a passion of mine since I was a home builder. I want my kids to live in a nice new home, and we're just not building enough for them.
Yeah, I think everybody would agree with that. And one more comment before we get into some of our talking points and main discussion here on the chart where you talked about the BFR groups buying, I think it was 15% of finished lots in 21 or 22, and that dipping down to 5 currently. And this is my gut, but you'll know better. I think a majority of BFR operators tend to buy at CO. So is there a way, if the public builders are increasing their share of finished lot purchases, is there a way to track, what percentage of those might be going to BFR buyers that buy at CO?
You know, we do track public builders' earning calls every quarter. That's another report we produce. And I don't have those stats on top of my head. And some groups are much better at sharing that type of information. So I know it's a growing business for a lot of public builders. You know, right now, the CO business has slowed down because of the capital markets issues, but it'll come back and they'll be delivering more homes to build to rent investors in the future. I don't have a perfect stat off the top of my head though.
Yeah.
And Michael,
No,
just
that's
to
that's
add there, just from sort of lender perspective, we are seeing more financing requests at sort of all the phases of build for rent development. So there's always people that are developing land and then selling to the builder. But
Sure.
we're seeing a lot of people that we know originally were intending to develop and go vertical themselves that are just deciding to flip out on land, and obviously land's sort of being priced at a premium right now, as well as we're seeing mid project, not the best scenario, sort of people looking for dispositions, and then certainly the same realm of CO. At the same time, we're seeing more CO bridge loan requests, as Don alluded to, with the cost of permanent financing and then what you're locking into, whether it's prepays or defeasance. There's a lot of people that are just sort of looking to bridge until the good old Fed drops rates type of thing, which, to me isn't interesting. Is that a real strategy or a luck and prayer type of play? But we're seeing it on all ends, and some of this is still planned. Many people plan to sell at CO, but the interpretation from our perspective is a lot of this is very much unplanned, and that's not necessarily the most positive. But to Don's point, it's going to keep moving. There's certainly demand for it on all ends, and especially at the end, tenant base. So.
Yeah, well, I think that leads into our first question, which I think all of you can answer just based on various degrees of where you fall in the deal. But how have you seen the investment opportunities being created in the current market, and what types of deals are being targeted? And maybe Nate, we can start with you because you're kind of frontline. Julie, you probably see it, further down the road once the deals are pretty baked. But would like to get some comments from all of you on these two questions. So where have you seen investment opportunities being created, and what types of deals are being targeted, whether it's SFR or BFR?
Yep. So specifically where are built for rent deals being created, I can tell you I see a lot of it in pro formas. So that's a very intentional point to make there. We're still seeing a good healthy amount of deals, although the amount of them has declined sort of at the same rates that Don showed in a reflection of the land acquisition chart there. But unfortunately, as we sort of get into our own underwriting, whether you start at the top with income or look at expenses, and then thereafter you get to your NOI and debt service coverage, just deals aren't penciling out. That's a known thing, but at the same time, another sort of obvious statement is, where can people find yield? And so the specific trends that we are seeing and I'm seeing is we're seeing a lot more secondary and tertiary market projects. And some of that's just a depiction of where we fall in the land of capital options from a lending perspective. But then within that subset, we're seeing, the two routes, which is one, markets that are more tertiary and sort of have zero proof of concept for anything built to rent. That puts a lot of pressure on the sponsor's underwriting, not to mention the lender, even the equity provider's underwriting. And it's, there's more and more data that's available from groups such as John Burns to make very educated decisions on it. But when there's no true comparable, and you're having to extrapolate out to other single family existing for rents or other new construction, analysis routes, it gets to be difficult. And then you tend to be more conservative, and that doesn't help getting deals to pencil. The other one in sort of the secondary, tertiary markets that we're seeing is sort of known areas that have existing build for rent completions, almost completions. And then we're seeing the new request to, call it start going vertical off of developed lands. And the challenge there is obviously, well, is there continued demand? And when will we know what's going on with the completions? what's about to go on with the ones that are about to come online. Now we're looking at financing requests for new going up, and having to push out 12 to 24 months and where we think things will be. Those are the challenges that we're running into. But again, the where is it being found is more of the secondary, tertiary from the stuff that we're specifically seeing. And then I will say that it was interesting if you really try to look at the map that Don showed on types of product. And it was hard a little bit because there was overlaps of coloration, but we're also seeing more higher density plays, call it the townhome plays, in areas where there was sort of more, from what we've seen, at least more of the single family play as well in the build for rent side. And so we're just seeing people look to, my gut says that that's just for people trying to find yield and maximizing sort of their return on their cost and land basis and ability.
Yeah, that makes a lot of sense. And I know, Don's going to have his pretty good thoughts on this, but Julie, you kind of enter deals, and I'm sure a lot of groups have programmatic deals or sharing their pipeline with you, but where are you seeing the request for insurance quotes coming in prior to groups closing on deals, whether they're SFR or BFR deals? Are you seeing a concentration anywhere more so today than a few years ago potentially?
We're seeing, we're pretty much seeing a lot of it across the board, pretty much everywhere. A lot of it is in suburban areas. Ironically, we have a lot of requests recently in suburban outside of Houston, which is kind of shocking considering it's a very large risk exposure down there from an insurance standpoint. But in terms of shifting gears, I guess, from investments having to like a little transition their strategies a little bit, we're seeing a lot of our SFR portfolio investors kind of move into the BTR space. And where we're hitting difficulty on our side is the concentration of these communities is really hard from an insurance standpoint because carriers see the concentration as one tragic event can come in and wipe out your entire community. So that's where we're seeing issues from an insurance standpoint. We have clients who, like you mentioned, in the market, it's unpredictable right now. They were once getting offers, before projects were complete, and now they're at CO and they're still holding on to the asset. They've kind of had to pivot a little bit into transitioning their deals. We have experiences, at least in the past month, with probably 3 different large clients, all in suburban Texas and also Georgia. So it's just offers aren't coming in as frequently as they were, back in previous years, and we're having to pivot with them. Their builder's risk policies are now having to be transferred into long-term tenant policies or long-term, vacant until they do get tenant. So, we're just trying to shift with the investor as the market changes.
Yeah, it's interesting. How are you on the insurance side? How, specifically in build for rent and on the horizontal or cottage style product, those units can be insured individually, but are you seeing on whether it's townhome, duplex or detached product, are you seeing buildings being insured individually or a project being insured in its entirety from a deductible perspective?
So you build at scale, but insurance does not replace at scale. It's all on an individualized basis. So, you might, as an investor, build at scale at maybe $85 a foot, but these carriers are looking at it on an individualized basis, whether you have one or you have one asset that has 4 different units in it, or like a townhome structure. Everything is going to be individualized. And a lot of these carriers, regardless if you built it at $85 a foot, they're going to have a minimum requirement of you insuring it for at least $140 a foot. That's just what we're seeing in the current market right now. So yeah, that's kind of what we're dealing with on the front end. We just had a client who has a large BTR in I want to say it's in like Illinois or something, and he just completed the project at $85 a foot. And we sent it out to all of our markets, and here we come back, and this is our best quote that we can offer you. It's at $140. None of our carriers are willing to go below the $140 mark in today's market.
Wow, that's interesting. And I'm reading clips in the news today about a lot of storms in the Midwest. So hopefully it's not too bad on our industry. Don, you guys doing all these feasibility studies around the country, where are you seeing kind of the most opportunities being created and targeted deals? What do those look like?
Yeah, that's a great question. And I would agree with a lot of what Nate said. In some of these secondary markets, new apartments, new build to rent units just haven't been built for a long time, right? And so you can go into a small market where nothing's been built for 10 years from a rental perspective. And so we're seeing some really great performance in some small markets like that. But obviously the risk there is, as Nate said, how do you prove it? And so we've been calculating rent premiums for this product and comparing it against scattered SFR or apartments for years, and that premium has come down, but it's still pretty substantial. So it does exist. It is just harder to prove it if there's no comps. But like I said, we're seeing strong performance there. And then when you get into, I'll say some of the core markets like a Phoenix or an Austin, where we've seen just a lot of new projects come in from both apartments and BTR. And at the same time, everybody's getting squeezed by inflation. So there is an affordability issue there too. So we're actually seeing some negative rent growth in Phoenix and Austin. But in the long run, those markets will recover, they will return, and we'll see a lot of population and households being formed there. We just have to work through this slug of projects coming online. But like I said earlier, we see a lot of household formation coming our way for a rental product. So we've got to work through the next 12 to 18 months of probably a tough time. At the same time, we'll see continued household income growth, hopefully a little bit lower interest rates, which will help cost of capital, help cap rates, etc. So you really, I hate to say it, it comes down to blocking and tackling, right? You got to really understand submarket by submarket supply demand issues and making sure you're putting down the realistic rent that you think is going to happen now and in the future.
Yeah, no, I think it's an interesting point, because I'm personally a fan of Austin and Phoenix today to start thinking about the future, because they were one of, I think, 3 or 4 markets in the country that decelerated from a value perspective as interest rates were, hitting their highs. But after 18 months, shockingly, I think to all of us, values in 90% of the country went up. And I think, I think the deceleration of values and rents in Phoenix and Austin may now be kind of at the, kind of at their lower levels. I don't think they're going to go down much more. So, given what John Burns is predicting on values and rents in both those markets through 27, they seem like pretty good markets to be looking at now. And just to make a quick comment, we have a national brokerage at SFRhub Marketplace that has a good view of where a lot of things are trading. And, most of the escrows that we have going today and the scattered tend to be in the, kind of C class, affordable workforce housing markets, predominantly in the Midwest and the South. And I think that's, just due to the higher yields that are innately a part of those deals. And, from a build for rent perspective, the capital markets are still tough to deal with. And, we're looking for opportunities and other buyers are looking for opportunities. But, given where rates and home values are at, it can get a little difficult to pencil. So it certainly in a time of sharpening your pencils to the finest tip.
Right. No, it's Nate said it as well. It's like, it's hard to get things to pencil right now, but now's the contrarian play, right? Everything's down. So if demand, see the challenge for us right now is the for sale side of the world is doing extremely well. There's a lack of inventory on the resale side, which is driving new home sales through the roof. Now, eventually that's going to normalize. Eventually, and we already believe we're past the peak lock-in effect. for mortgage rates. And so eventually that resale market will unlock, but it's going to be a while because we don't see rates coming down dramatically. We maybe 100 basis points over the next few years, and that's based on what the bond market's telling us. But as that dynamic shifts, where the capture of new homes comes down closer to norm, appetite for land will slow down, and that'll be a good time for this space to try to pull some levers and get deals done.
Yeah. Do you think, Don, that the I think it's kind of obvious that, you know, the greater supply that hits the resale market, you know, is somewhat of a negative for builders. But where do you think that inventory on the MLS and the resale market really needs to be to start squeezing the builder margins that are at arguably an all-time high? And you have better stats on that than I'm sure I do, but you know, they seem to be, you know, operating at almost double where they were for 5 years ago. And I think a lot of that's just that there hasn't been anything else available. You know, but yeah, you know,
historically, new homes have captured around 13 to 15% of the total housing market. New home builders got above 33%, I think, or right close to that. And now it's hovering around 27, 28% of total market. So, you know, a lot of people just historically have said six months of supply is reasonable and expected. We think because of technology and being able to buy a home without going to see it, everything is sped up. So we think that normal months of supply is closer to 4.5 months of supply. So that's probably where we need to get closer to that to put a little bit of competition out there for the builders.
Michael, can I ask you a quick question, my friend?
Yeah.
So I know you guys have tons of visibility to this, but like in regards to anything that you're seeing trade or trying to be traded, is there still pretty a wide gap in sort of the pricing discovery or lack of alignment or alignment between buyers and sellers? Like any just feedback on that? I'm just interested in what you're seeing with the number of transaction y'all touch.
Yeah, I mean, there is, you know, the biggest challenge today, that especially on our brokerage side, you know, is that sellers, if they own, you know, 20, 50, 100, however many scattered homes, you know, they can get a really good feel of what the retail value is for those homes, and they apply those values to their homes, which, you know, almost inevitably puts it out of reach to cover a debt service coverage ratio for an investor. So we, you know, have to spend and do spend a lot of time, you know, thinking through that with the sellers and say, okay, well, if you are intent on selling and, you know, you believe your home is worth X, you know, are you considering that you've had a tenant in place for 2, 3, 4, 5 years, and in order to get the value you're anticipating, you need to remove that tenant, you know, put in the CapEx into the house to get it to that retail level to achieve your value. And then do you want to do that 50 times this year in order to sell one-offs and hope to hit your maximum value? Or, you know, will you consider an offer that is whatever that percentage difference is? Maybe it's 5, maybe it's 10, maybe it's 15% off your value. That will give the investor the opportunity to utilize the cash flow to work with somebody like you to get a loan, and then, you know, being part of SVN, which is, you know, the 6th largest commercial brand in the world, will, you know, try to get the sellers thinking along the lines of 1031, like, okay, you know, you don't have to do all the work and invest all the capital to improve your home to the retail value that it could be at today, which it isn't with a tenant in place. Is it, you know, more beneficial to you to take a perceived discount on your value per home, sell in bulk, and then, you know, put that money into a 1031 and buy any other asset, say it's a Starbucks or some triple net, that's going to be hassle free for, especially the aging demographics that, might have been operating for 20 or 30 years as mom and pops, but they don't want to deal with tenants and toilets any longer. And, they can take, what I think is a perceived discount, but then buy something right, save on taxes, and you end up making a lot more money in the long run. But it's certainly an educational process, because a lot of sellers, they're just looking at the retail values, and, a home on 123 Main Street next door to theirs sold for X, okay, well, to get to X, you need to remove your tenant, put in 30 grand in the home, now you can get that, but is it worth your time? It's really a time value of money question, and really a lot of just, thinking through different options and getting them educated on what it takes to get there. But there is a disparity, certainly today. And then, some just bought at the wrong time, and their costs in the deal are very, if you bought in 22, and you executed a value add plan, today, even if your rents are doing well, you may be, a little over your head. So I think there's going to be some opportunities for groups to come in and maybe do some equity infusions and partner on deals, or we'll see. I think this year is going to indicate a lot of opportunities, and I don't think there's going to be distress, but I think there's going to be some people that are in some challenging positions that will need to make some tough decisions. Don talked about where rents are moving, and I think everybody agrees that rents are going to be going in the right direction for the next several years. But and I'll start with you, Nate, and Julie, and then end with Don. But what market trends are you following or paying attention to most closely right now? Nate?
Yeah, so I guess just briefly speaking, I mean, rent growth and assumptions, but it's it's an easy one, but it's very, again, unique and idiosyncratic to individual project and specific market that it's in. Everything points and shows, I think as Don had mentioned as well, occupancy is not an area that we feel like we need to follow closely. We definitely think that there's continued demand. And then really it's just sort of the watching any potential shifts in market fundamentals from the population to job growth sides in some of these, especially secondary, tertiary markets, because without the underlying fundamentals, ultimately the investment strategy is going to be certainly challenged. So candidly, it's not too much outside of the normal, just sort of scrutiny and analysis on each realm of assumptions. I think just personally, the one cool is just sort of seeing what we thought would happen from the pandemic and the change in people behavior has really come to be true. And so I'm just personally interested in sort of the next realms of trends in regards to like amenities and technologies and some cool new whiz bang stuff that I know is going to come to market that's probably going to blow my mind, that I'm excited to see. So that's sort of the spectrum of where my mind goes to that.
Yeah. What about you, Julie? Any thoughts or trends you specifically like to follow?
I mean, just given the nature of my career, I follow insurance trends, read a lot of insurance, super exciting articles about insurance. Yeah, so we're just keeping a close look on, where rates are going in the market. Typically the insurance market will follow where the current economy market is. And in terms of rent, I think Don had a lot of good things to say. I am also an investor myself, so I like to see, what's happening out in the world. We have some smaller apartments, so more on a smaller scale than I'm sure some of these investors are. But I really think that rent is subject to supply and demand, like he mentioned earlier, and then where the existing market is.
Yeah, oh, that's great. And Don, I don't even know how you would find a favorite or one you like to target on, given the vast amount of data you guys are driving down through a funnel. But what do you think for you, or maybe John Burns, real estate consulting group in general? What are the key trends you're really paying attention to today?
So great question. Thank God we have a huge team, so we look at it all. But when it comes to specific projects, it really is looking at it from that micro view. What is going on in my submarket? Am I going to be the only guy or gal here, or is there going to be 10 other projects built right around me? So that local supply and demand is super important. Truly understanding the demographics, who's there, who are you going to be able to attract, and making sure you get the rents right. And going back to, I think Nate touched on it, the work from home movement. So one interesting thing that came out of our BTR survey is we also asked the tenants if you work from home or not. And 2 out of 5 either work from home full-time or part-time. So it's that we don't see that trend changing. And so people will be able to live where they want, where they can afford a nice home and have a job somewhere else. So that's interesting to watch that. Clearly watching what's going on with that domestic migration. The shifts that we have seen have been astonishing. So really, really understand who's moving into your community still. Is it still happening or not? Because it has certainly changed. And then just from a product standpoint, I've seen a lot of innovation. You talked about somebody, I think maybe Michael and Nate talked about densification. We're definitely seeing that, but I think we need to remember, and let's not go crazy. People still want the privacy. They want a yard. That's why they're moving out of higher density units. And we're seeing a lot of innovation in horizontal apartment type product. We're seeing 2-story homes there, so they can preserve that 12 views per acre target, but bring in a driveway, bring in a garage, which people love. And they love that private rear yard as well. So then the other trend we're seeing is multiple different product lines in one community. So the projects we're doing, the number of units is growing, 250 to 300, or even a lot more, where you might have a segment of your property is going to be townhomes, a segment's going to be horizontal apartments, and then you might have a detached community. So just like we see on the for sale side of the world, multiple product lines in one community to target a broader demographic profile to help speed up the absorption for the entire project.
Yeah, that's great insight. And gosh, I got to say, I looked at the clock. I thought it was only a few minutes ago, and it was 20 minutes ago. So we're getting close to wrapping up, and I want to get a couple questions from the audience if there are any. But lastly, and we haven't gotten through all of our talking points, but I think this is a critical one, specifically for you, Nate, and the audience. You know, and maybe you can answer SFR and DFR, but what is the current typical underwriting criteria that everyone should be considering in evaluating new opportunities?
Yeah, so I think just from an assumption basis from the lending side specifically, the amount of leverage, and especially on the loan to cost perspective, which is really also driven down by sort of what current and future value expectations are, has gone down about 5% in some scenarios, depending on the capital source, about 10%. So, where 75% loan to cost was very much the norm, and you could possibly get up to 80%. It's something that we've offered, is now more like 70 to 75. And then depending on if you're using more institutional type lending and capital sources, it gets into sort of the 60s as far as what you can expect. It just depends on sort of what you're looking for, what's most important, leverage, or sort of cost of capital from the debt side. I think, at the same time, is to bring in the equity side. I mean, there is still a lot of capital options for lending. Equity has been more patient than the debt side. As far as other assumptions, it's just really, what is your takeout interest rate? We stress every deal in 0.25% intervals to a range of about 200 basis point, 100 basis points on each side of where we think it is today. We size to agency takeout in sort of a blend of Fannie and Freddie. And so just depending on size and market and size of deal, you're looking at sort of mid 6-ish takeout rate, constant as they call it, to 7%, on small balance and small market deals. And then you're looking at, depending on market, sort of a 1.20 to a 1.30 debt service coverage. But again, like some quick moves in interest rates, from my projection is average consumer residential interest rate currently is in the high sixes. It's likely, in my estimation, is going to be 6.25 at the end of the year in Q4. So it's not a material drop. Could be less depending on how things go in the next couple sessions here. But, just as a lender, just talking about sort of what you can assume to get, that's the easiest way to talk about it, because any rent, occupancy, and other assumptions are very market and deal based.
Yeah, no, that's a great point. And we're at the hour mark. First I want to thank everybody for participating. It doesn't look like we have any questions from the audience, but for any of you out there that are looking at deals, please reach out to Julie to discuss insurance opportunities. Obviously, Nate, for loan quotes and suggestions on maybe what might be necessary to work through a project to achieve a desired loan. And obviously, Don, with his unlimited data at his fingertips, it's invaluable to have that kind of data when you're looking at deals. And feel free to reach out to myself with any further questions as well. Before we end here, I guess we'll just start with Don, go to Nate, and end with Julie. But any final thoughts, or just top of mind for the year 2024 that you'd like to bullet?
For me, it's education, and really it's educating local governments, local community groups, and national politicians that build to rent is not a bad thing. It's a good thing. It's a product that people want. Anytime we add supply to housing when we have 2.1 million shortfall is a good thing. We just need to get governments to help get homes built.
Yeah, I couldn't agree more. And Nate and Julie, before we get to you on your last comment, I speak with a lot of developers that are looking to get into the build for rent space, and dealing with the local municipalities and the cities and the neighbors, and these meetings that developers have to have with the neighbors, getting everyone educated on the quality that these build for rent projects are maintained at, because they're professionally managed, and how they look 5 years later compared to a nearby for sale subdivision, I think is something that people need to stress on, because like Don mentioned, there's a lot of affluence and there's a lot of people choosing to rent, and they're shopping and dining, and their kids are going to school with the kids that live in a retail consumer's home. It's not the typical NIMBYism that the apartment market has always kind of had a negative shadow over it. These are families and people that are choosing to rent, but they're benefiting the community, and the communities always look good down the road just because they're professionally managed. Nate, any final thoughts?
Oh yeah, just I asked a question earlier of sort of what tailwinds, but I don't know if it's tailwinds or headwinds. It's certainly whirlwinds. So but on the optimistic side, I would just say, look, there's as much, if not more, demand for rentership than before. The cost of rent versus cost to own is flipped completely since sort of pandemic and post-pandemic timeframes here. Additionally, there's still plenty of capital options. But if you also look at the institutional, investor demand side, just spreads on single family cap rates is tighter to spreads on multifamily cap rates than they've almost ever been historically, I believe. At least that was the same the end of last year. And then lastly, I'll just say there's more data and information on build for rent, whereas there's a lot of speculation in new markets or markets that may be saturated. But whether it's John Burns Group or others of the like, there's more data accessible. And so it's just stay optimistic, stay in the game if you're in it for the long haul, but just make sure that you are maximizing what is available in today's market to make the right investment decisions.
Great point. Julie, final thoughts?
Yeah, we actually had a couple of questions come in the chat box about insurance. So I wasn't able to. No, I answered them directly, so I wasn't able to like chat on here, but I did want to let you guys know if you have specific insurance questions, just to reach out to me directly. I put my contact information in the chat box for you. But just a quick overglance on insurance, our pain points remain to be all coastal markets, Florida, Louisiana, anything south, and then those areas that are high risk exposure or high wind exposure. So that's going to be Colorado, Texas, Oklahoma, all up in that tornado alley. I don't foresee any changes in insurance rates in the near future. Right now, we're in a very hard market. The good news is, historically speaking, hard markets don't last more than 7 years, and we're at that 5-year mark. So there should be some light at the end of the tunnel. In order for us to get back to a soft market, which is where we see rates going down, carriers coming back into markets that they once have declined or come out of. Florida in particular, a lot of the apartment markets in California. We really need to see costs of construction going down. That is a huge factor. So what I always tell my clients is to underwrite risks as if you're going to experience a very large loss, especially if you're in those areas that have high wind exposure. Florida, keeping a very large cash reserve in pocket just for those deductibles that you will have to pay out of pocket for wind. So anything further that you have insurance related, please reach out to me directly. I'm happy to help and answer any questions you have.
Well, that's I think a wonderful time to end. Forecasting the pains of the insurance market, maybe nearing their end, is a big help to any investor and operator out there. So again, I want to thank everybody for joining our pieces of the puzzle on where build for rent opportunities lie in the current market. And I wish you all a good day and a good week and a good 2024. Thank you.